So now we're going to talk about the underwriting process for your loan. Here's how the underwriting process is going to work. Your lender, your loan officer, they're going to take your pre-approval and they're going to work on finalizing it into a full approval or commitment. So likely they had most of the documents that they needed. They'll probably need to button it up, which is a little bit more information, or actually a lot more information. They're going to want to make sure you can pay back your loan. They'll examine and document the risk of the loan, and that's sort of the whole process. The lender's about to give you several hundred thousands of dollars. Put yourself in their shoes. If you're giving a friend a loan, you'd want to make sure that they have the ability to pay that loan back, so they don't go off with your several thousands of dollars and default on it. So that's what the lenders have a legal obligation to do, to make sure they're giving a loan that's based on government regulations that you can pay back. That's essentially what they're doing here. So they're going to ask you for a lot of information. So just expect it, roll with it. It's not fun. They're not picking on you. It's just part of the guidelines. So go through this process. You'll be talking to your loan officer or their loan processor a lot. They'll be helping collect these documents from you. So when they ask for information, you really want to get it to them as quickly as possible so that you're not late on your mortgage commitment date. They're going to take your pre-approval information, send it to the underwriter. The underwriter then comes back with a conditional approval. A conditional approval is like they say, your loan's been approved, but please send us the following documents. The conditional approval is saying you're close to the loan getting the final clear to close, but we need a couple other things from you. And by a couple, I mean probably a lot. There might be quite a few documents depending on how complex your loan is. So they might come back saying something like, we need page 3 of your bank statement, or we need evidence of your homeowner's insurance, because they need to see that you have homeowner's insurance. We'll talk about that a little bit later. Maybe they want to see an explanation of address 123 South Street that came up on a report. Maybe it was a past address they looked at, then there were some flags on it. They might need your most recent pay stub because the one you have is too old. They might need to contact HR or your manager to get employment verification. It's usually things like that. Sometimes this conditional approval can come back and be like, oh my God, I'm not going to get my loan. It's going to fall apart. They need too many things. That's not the case. Don't panic. An initial approval is easy, but a conditional takes work. It's a very, very, very normal thing. Normal thing. So expect it. Homeowners insurance comes up a lot. It covers things like natural disasters, damage to the house from that. You can shop around for insurance coverage to find what works for you. Look online, ask friends who they're using, or you can usually go with whoever has like your car insurance or things like that. You can go ahead and shop for multiple quotes if you have the bandwidth. But your home insurance is going to be included in your monthly mortgage payment. That happens most of the time. And that'll be covered at closing with your attorney and lender. Also, a lot of people don't realize that your first full year of homeowners insurance is going to be paid up front and included in your closing costs. It should be included in your loan estimate as well, 12 months of homeowners insurance inside the prepaid section. It can be a little bit confusing because they're collecting 12 months up front, prepaying the first year, and then also collecting the monthly amount into an escrow account. And if you sell the home within a period of time and there's homeowners money in the escrow account, you're going to get that money back. Any money that's sitting inside your escrow account, if you sell or refinance, you get it back. We can talk about that later. An escrow account is basically where the lenders are taking these bigger payments like insurance, taxes, things you pay once a year. They'll collect that monthly into a stored account, and then they'll pay it for you as part of your mortgage payment. Anyway, so at this point, the lender's going to order an appraisal for the property, and we will cover that in our video on appraisals.